What taxes do landlords pay when selling investment property? In this video, we'll introduce the 2 taxes landlords need to know about when selling buy-to-let property. If you own property personally, you'll pay capital gains tax, and if you own through a limited company, you'll pay corporation tax on the gains made. Firstly, what counts as a gain? I'm James Poyser. I'm the CEO here at Provestor, the property accountants, and we're here to help you with all things property tax. A gain or capital growth is the difference between the price you paid for the property when you bought it and the price you sold it for. For instance, if you bought a property for £100,000 and sold it for £150,000, your gain is £50,000, and this is the amount you'll pay tax on. The good news is that the costs of buying and selling the property count towards reducing the gain. So things like solicitors' fees and agents' fees can be deducted. If you've invested to improve the property, perhaps to refurbish the kitchen and bathroom, or you've added an extension, you can also deduct these costs from your gain. That's why it's really important to closely track your outgoings throughout the life of your property. If you're a Provestor client, our app makes this really straightforward. So you've got your £50,000 gain from the sale of your property. Let's take a look at how much capital gains tax you would pay if you owned that property personally. The rate of capital gains tax is 18% for basic rate taxpayers and 28% for higher and additional rate taxpayers for personally held properties. The good news is that there is an annual capital gains tax-free exemption, which is £12,300 for the 2021 tax year, and this can be deducted from your gains. If we go back to our earlier example, a basic rate taxpayer would pay £6,786 of capital gains tax, and a higher rate taxpayer £10,556 of capital gains tax. So we've covered capital gains tax for personally owned properties. What about limited companies? Do they pay capital gains tax? Well, whilst it's not technically called capital gains tax, you still have to pay tax on the gain when you sell a property from a limited company. Unfortunately, you're not entitled to use your personal capital gains tax-free allowance in your limited company. However, for higher rate and additional rate taxpayers, the overall rate of corporation tax can be lower via a limited company. Before we continue, I just want to call out some free resources that you might find useful. Head to the description below and you'll find links to our expert guides, calculators and fact sheets, all of which are freely available on the Provestor website. Check them out and let us know in the comments if you found them useful. Let's go back to our example. After the personal capital gains tax allowance, our higher rate taxpayer would pay £10,556 in tax. In comparison, our limited company will pay 19% corporation tax on the £50,000 gain, which is £9,500. So there are a few things to think about depending on your strategy. There are multiple ways to reduce your tax liability when selling a property, and we recommend discussing this with a property accountant who can recommend strategies specific to your situation. Provestor clients have access to 4 consultations a year to help with their ongoing tax planning. We also offer one-off consultations, so if you're planning to sell your investment properties and need advice, this is something we can help you with. Click on the link above to find out more. Thank you for watching this video. I hope it has been a useful overview of taxes when selling investment property. If you found it useful, please like this video, subscribe to our channel, and if you have any questions, drop a comment below. I hope you enjoyed this video and I'll see you in the next one.